Today's blowout housing numbers show home sales in July surging 25% versus June, while supply is down over 20% from a year ago. Could housing be what gets the economy to line up with the stock market? For more, I'm joined by Constance Hunter. She's the chief economist at KPMG, and Caterina Simonetti is senior portfolio manager for UBS Private Wealth Management. It's good to have you both here. And Constance, I'll just begin with you. I mean, housing, in some cases, like Ed Leamer has said in the past, is the business cycle. So is this telling us that there can be kind of a V-shaped fundamental recovery, not just one in the stock market?
So, yeah, housing's a leading indicator, and it was actually turning in the quarters before COVID hit. And it was just starting to come around because the Fed had lowered rates in 2019. And of course, we're seeing a big rebound now. It's unclear if this is going to be sustainable. We're up about 8.7% year over year based on today's data. And we're almost back to February's pre-crisis levels in terms of existing home sales and in terms of housing starts to address the issue with supply, right? So certainly low interest rates really help with that. And we're seeing a lot of people at home, right? They're reevaluating their home environment. So that is spurring a lot of purchases of both new and existing homes.
Yeah.
And So we really think of it as FOMO versus FOGO. FOMO, fear of missing out, and FOGO, fear of going out. All the FOGO aspects of our nature are driving the economy and the stock market right now.
Yeah, fair enough. And Caterina, I'll ask you if all of this is already priced in. I mean, especially in the housing sector, we've talked about the massive runs in Home Depot and Lowe's in the home builders. But does it give you more confidence in the stock market overall, or are you still concerned that things there have just gotten too stretched?
Kelly, thank you for having me on the show. I agree with Constance. I think that the housing markets is a very positive development. This run-up that we're seeing certainly points to the improved consumer confidence. And as we're looking at economies continue to reopen and just overall this V-shaped recovery, which we're thrilled about, but we still can't discount the fact that the economy is not fully recovered yet, and we still are facing the uncertainty of the upcoming election. We're facing the things that we're focused on, leading up to the fall, like trade tensions with China and continued threat of the virus and the absence of the vaccine. So, having said all of that, we are expecting heightened volatility for the months to come. But this is certainly seen as positive development.
You guys basically, Caterina, have three recommendations. You think people should get into cheaper segments of the market to benefit from the next leg up, so mid caps, maybe global equities, some value names. The themes like Constance was describing that are accelerated by COVID-19, so that's 5G, the digital transformation and so forth. But you're also recommending some defensive plays like gold, like long duration treasuries. You think there's still value to be had there?
Absolutely. Specifically to investors that feel that they've missed the rally. We think that there's still time to get in as long as they do it strategically and defensively and hedge their portfolios with the defensive plays like gold, like long duration treasuries, just like you said. Because the reason for this is, as I mentioned earlier, we're expecting a lot of volatility, but we also expect that there is going to be a lot of buying opportunities as we see them right now in sectors that have not benefited from the next leg up. And as tempting as it is to be buying high flyers, we are encouraging investors not to fall into this all this time trap of buying high and selling low. And instead, we ask them to be defensive, to be strategic, and as a matter of fact, use this time to rebalance their portfolios, which will be extremely.
It sounds simple, but it's hard sometimes to buy low and sell high. It's harder than it sounds to do it consistently anyway. Constance, let me bring you back in. You've pointed out that we kind of need to be on the watch for lower rates here as a result of everything that we've been through. So even with the rebounds in housing that we're talking about, even with the rebounds in the market, why do you think this low rate era will stick around for the time being?
Yeah, it's a great question. I mean, our forecast for 10 years is for it to really remain below 1% for the next year. And a lot of that has to do with what we've seen in previous pandemics, right? We've seen lower real rates after previous pandemics going back several hundred of years. And we have increased savings as a result of the pandemic. And that's happening globally, by the way. We're seeing that from China to the US. Households are saving more. That higher precautionary savings pulls back spending, causes a disinflationary environment. And so we think that there is scope for yields to remain low on their own. Furthermore, we wouldn't be surprised if yields do start to inch too high and choke off the recovery too early. The Fed is probably going to come in and try various modalities from jawboning all the way to possibly implementing yield curve control.
Yeah.
To keep rates low, to make sure that we sustain, because as Katerina said, before the vaccine, we're in for a very roller coaster type experience of fits and starts. I mean, Bob Pisani was mentioning the PMIs in Europe. We're starting to see cases tick up in some European countries and countries that they really thought had this under control. So until the vaccine comes, we're in for a little bit of a rocky ride, and therefore the Fed is really going to try to make sure that rates are as low as possible to support the parts of the economy that they can support.
Well, I know you're doing your part for the home improvement economy. The plant looks great.
Thank you.
We'll see if Rate in My Room agrees. Constance Hunter, Katerina Simonetti, a pleasure. Thank you both. Here to talk about the markets today.